Okay, that's Robbie. Let's do a quick sound check. You can hear me still okay, can't you?
Yep, sounds good. Can you hear me, Phil?
I can hear you too. So I think we're live. We're just at 1 minute to the hour. So I know people are already dialed in. So if you just bear with us and we'll get going. We just want to allow enough time for everybody to dial into this webinar. So people are dialing in. I know we're on the hour now, but we just wanted to give it a little bit more time to make sure everyone gets the opportunity to finish off their meeting and then obviously dial into this one. So we'll almost probably give it just a little bit over a minute before we get started. Okay, just saying again, we're just going to give it a little short while just to give everyone the opportunity to dial in. And then we can get started. Okay, well, we're closing in on 2 minutes past the hour, so we can make a slow start. And a short while. Okay, right. Well, 2 minutes past the hour. I'm sure people will be able to catch up. But no, thank you everybody for dialing in today. And hello everyone. Welcome to the ODCE analysis overview of the NCREIF ODCE Index results, the latest results to Q3 2024. I'm Phil Tiley, head of our performance and valuation analytics part of the business. I'm joined, as usual, here by Robbie Tangent, who heads up the advisory delivery side of our business. And over the course of the next hour, we'll be taking you through those latest Q3 ODCE result numbers. This is based on the entirety of the ODCE data sets of all 25 funds, and within ODCE we've got an extensive valuation data set. We then matched that up against the ODCE funds to provide a bit more added intel into the analysis. So the webinar is a kind of wider market insight for our kind of overall client network, but it's also a kind of precursor to a lot of the one-to-one client conversations we have with those clients who are ODCE and NCREIF members that get this analysis effectively replicated on a comparative basis. We look forward to having those conversations in the weeks ahead. Before passing over to Robbie, just kind of thanks to everybody that's been involved in getting all this information pulled together. It's very much a very collective effort. So everyone in our advisory business, people that work alongside me in the performance team, our clients in particular, they provide us with privileged access to their data, and NCREIF providing the benchmark numbers. We'll have a few polling questions as we go through. Robbie, do you want to maybe kick off with the first of those? If I just move on, and you can just kind of kick off with where pretty much we finished off last quarter. If I can move my slides on, there we go.
There you go. I think that the other thing as well, right? So if there's any question, please put them in the question box, right? So and our team will try to address them, or we're trying to address them at the end. If it's not, we'll address them after the webinar, and maybe during the one-on-one with our client as well. So to kick off the webinar, I think this is what we always ask every quarter, right? So what is the total unleveraged property return to be basically expected in 3Q from based on last quarter webinar, right? So I think 69% of them picking between 0 to 1%. I think the people win again, right, Phil? I think the majority can pick it correctly again this time around.
Yeah, again, they do. The majority gets it right, and actually the result kind of finished off in the kind of top end of that bracket. And let's get in straight into the results. So as you can see here, finally reaching that inflection point in Q3, those returns turning positive to 0.8%. That brings to a close what's been a 2-year run of negative performance numbers. There's still a bit of trade-off within that number there between income and appreciation. We can come onto that. Providing some historical context, the last time the ODCE index delivered a profit to its investors was there back in Q3 2022. That's the back end of that kind of, as we've termed it, the post-pandemic upswing, during which returns reached record highs of almost 7%, and that follows on the momentary setback when the returns turned negative at the onset of the pandemic. Most of this kind of upswing has now been reversed during this kind of recent period of decline, but that performance profile, as you can see here, has been steadily improving through the course of this year, and with it turning positive in Q3, hopefully now the worst is now behind us. Just to clarify what the numbers are here, what we'll be talking to is the kind of pure real estate side of the ODCE. There's no leverage, no cash, and no fees in these numbers. But let's immediately kind of break that down, that performance series, into its income and appreciation levels, putting again some historical context in there. So if you go right to the right-hand side, the market still is technically in decline from an appreciation standpoint, negative 0.4% for the quarter, but we now have that net positive trade-off with the income return, which has been, you can see those green bars, steadily increasing quarter on quarter. This by definition is the return on income over capital, and obviously as the capital base has been declining, the return on income has effectively risen. So it's more about the improving metric there is less about an improving numerator, more about a declining denominator effect. But on the red bars, appreciation wise, we've been breaking the recent cycle into kind of 3 distinct periods. I was kind of hoping we'd be adding a fourth this quarter, but not quite yet. You backtrack here to the kind of momentary right down at the onset of the pandemic. That's then followed by 7 consecutive quarters of growth, during which just shy of 23% has been added to property values. The majority of those gains, though, have now been cancelled out, with now 9 consecutive quarters of declining values, or to be more precise, 9 negative returns on appreciation. That distinction is quite critical when it comes to understanding or picking apart the most recent performance number, and we can actually get into that straight away, because what we're able to provide at Altus is that kind of added insight into that appreciation piece. By drawing on our valuation data set, we can determine how much of these movements in values are down to the kind of pure economic fundamentals, and how much of it is down to what might be termed the investor sentiment or the capital market side. So regular listeners will be fairly familiar with this drill. So we first transpose the red bars here, the appreciation, onto the red line on this next chart, and we bifurcate that appreciation in terms of what's termed the yield versus the cash flow drivers. So the yield effect, the yellow, is how much the movement in value is dictated by the change in actual valuation levels, changes in discount rates, exit caps. The cash flow, the blue bars, is how much of the change in value is down to the change in those forward projected cash flows that are effectively being priced by those yields. So focusing here across that current period of decline, its yields that have clearly been the main protagonist, having risen, lowering values largely in response to that step change in the interest rate environment and the associated increased cost to capital. That downside has significantly tapered off and continued to do so this last quarter. Robbie, in a second, it'd be good to get your thoughts on how that kind of September 50 basis points cut from the Fed had kind of played into that easing metric, and also given maybe what we might be hearing almost during the course of this webinar. But before you get your thoughts on that, let's turn to the other side of the equation. So this kind of period of elevated interest rates, which has been challenging the market from a pure pricing standpoint, has also coincided with a pretty fallow period when it comes to the cash flow side of the equation. I mean, cash flows have just about held up, which is not necessarily a bad thing, but there's been no real positive cash counterbalance in that respect. And if you look back over the history of this chart, it's worth reminding ourselves that it's predominantly the cash flow gains that created value for real estate, and the back history here really illustrates just how important that kind of improving cash flow piece is to the whole appreciation narrative. Those cash flows actually did start to get scaled back at the earlier part of this year, but thankfully that metric has now turned positive into Q3, and that improvement in cash flows has now counterbalanced what is a very minor offset from a pure pricing standpoint. So effectively leaving values in Q3 at a standstill. I mean, what turned that appreciation number negative was actually the third component on this chart, the grey bar, and that takes account the amount of capital that's being invested into these properties during the measurement period to effectively maintain what was a leveling out of value. So, Robbie, to get your thoughts first off in terms of the gradual kind of easing of that interest rate environment, what looks to be a bit of an improvement in the fundamentals. I mean, it was also a pretty flat quarter, so maybe not a bad thing in that respect. Maybe the market, there's a bit of wait and see in those results, waiting for the next movement from the Fed, which obviously you might get confirmation on very shortly. But there might also be an element of limbo in there in the run up to the election from an economic standpoint. So a lot of questions there, Robbie, but just your initial thoughts around that.
Definitely an interesting period, Phil, right? So I think there's several surprises. I think the first surprise was actually the 50 basis point cut itself, right? So many were anticipating 25. So I think the other surprises as well, that who would have thought that after the Fed cut, actually that the 10 years actually not lower, but it's actually moved up, right? So at the beginning of the quarter, the Treasury was kind of about 4.04, right? So then it moved down to 3.6, 3.7 before the September 17 during the Fed cut, right? So, but since the cut, actually, then the Treasury moved up closer to 3.8 at the end of the quarter, right? So now after election, the 10-year passed 4.4. I think it's, as of now, set about like 4.35, right? When I checked a little bit earlier, right? So, and Phil, I think that's, as you mentioned, that another cut could be coming shortly, Phil. So we're pretty much taking everyone's time in here, right, from this unveil party from the Fed cut, right? So, but yeah, thanks everyone for joining this call, right? So, and then I think that on the Fed cut itself, right, although it's not resulting in the lower 10-year, I think it does provide the positive boost in the real estate, right? So at least there's some certainty of no interest rate increases in the future. I think that beforehand there's a talk about Fed actually increase interest rate, right? So that's removing the downside risk of the increased interest rate, right? So, and we're seeing that with the transaction, which are reported higher in Q3 compared to Q4, right? So I think that's one of the reasons as well that we're seeing less pricing adjustment this quarter, Phil, right? So with the lower yellow bar there, right? So definitely feel like a bottoming, right? So I think on the wait and see, definitely we're seeing that as well from the investor point of view with the election, right? So with the election result yesterday, regardless what our party affiliation, if any, right? So it does provide some certainty. At least we know the direction of the policy on the high level basis, right? So as we all know, investors generally do not like uncertainty. With some certainty right now, election kind of result, and then with the Fed cut and potentially more cut coming forward, it'll be interesting to see how that impact the capital side of the equation in the coming quarter. On the fundamental side, Phil, I think that it's very similar to the economy, right? So I kind of call it the resilient, right? So I know not every property are created equally. Office still definitely a challenge, right? So, but overall, we're seeing more positive movement, which we'll discuss further later on.
Excellent. Thanks for that initial insight there, Robbie. Actually, let's get into the kind of the sector variances straight away. So back to the actual returns on this next slide, if we can move it on. So here up top, you've got confirmation of that overall ODCE return turning positive in Q3. And then we're breaking that return back down below across the sectors, color coding them as to whether they're north or south of that ODCE overall average. Few points to note for this quarter. One, all sectors improved on their performance levels over the prior quarter, with the exception of offices. All sectors are posting positive returns, and that's actually both on an income and an appreciation side. And also down below there, we've got the overall dispersion across the sectors continues to narrow. In terms of the kind of the rank order, offices remain firmly rooted to the bottom of the order, the only negative return, but the pace of decline has eased off there, -2.5 to -1.1. That's actually part of the reason why we're now seeing less dispersion across the sectors. That and the fact that there's outside of that just 70 basis points separating the other sectors. There's about 10 basis points in it at the top end of the order between retails and other. The main part of other is self-storage, and they just sneaked into top spot in Q3. Apartments and industrials a little further behind, and actually apartments just getting the better of the industrials, but both posting robust single digit and above average rates of return. It's only the offices that are coming below the ODCE, but overall it's definitely an improving set of results across the board. And that overall improvement is actually better illustrated when you actually chart those results on this next chart. And actually by charting the results alongside one another, you can see just how clustered those performance levels now are becoming across the sectors. It's still a case of that green line, offices being kind of cast adrift from the rest, but they're also in step change in terms of that overall improved performance trajectory. Looking back over the chart, it does serve as a reminder of just how bifurcated the market has been, both in that kind of growth period when kind of industrials, that line there, were clearly in a league of their own, and throughout the most recent downturn when its offices have clearly been cast adrift from the rest. And you can see the effects of those variances better on this next chart. We take a slightly different perspective on the results, and we've done this before, and this sets out how each of those individual sector returns contribute to the overall ODCE returns. So taking the returns plus their weight. So to the Q3 number, you have that positive return in Q3 coming about with all property types now balancing out the downside from the office sector. But what this chart really brings home is just how different individual sectors have played their part at different times in determining the performance profile of the ODCE, certainly when you go back over the last 4 years. So backtracking to that momentary setback at the start of the pandemic, where most of that downside was purple, stemming from the retail sector, the subsequent growth period, which has really been driven by the lead performance, the red, the industrial sector, but supported by strength coming out of the multifamily sector. And then you've got that kind of demise within the office sector, really pulling down recently those returns in the current period of decline. It'd be interesting to see going forward whether one sector really starts to emerge again as a lead contributor, or whether we end up with a bit more of a balanced kind of setup similar to what we saw leading in the run-up to COVID. Next, let's drill into those actual performance variances by sector. So break things by income and appreciation, and to that kind of prior chart and that comment I made there, you can see that the write-downs at the onset of COVID were really fixed around the retail sector. That growth period is then dominated by gains in the apartments and the industrial sector, and then in the most recent period of decline, all sectors being subject to those write-downs, but by varying degrees. The offices clearly the worst affected there. In terms of the latest set of results, if you go to Q4, what's noteworthy is we've just crossed the divide in the apartment, the industrial and the retail sector, all with positive appreciation for the first time this last quarter. And obviously the exception there is the offices. Offices are ahead from an income return standpoint. The question remains though whether that income return is high enough to bring investment back into the sector. Let's then unpack the appreciation. So unpacking the red bars into those yield versus cash flow influences. Go to the right-hand side, and there's very little to choose there, and minimal interplay between the appreciation of the main sectors, with the exception of the offices. Offices aside, what's encouraging to see is that blue line has just turned positive, so cash flows are all in the ascendancy, with the exception of offices in the last quarter. Added to which, those yield impacts have pretty much leveled out this last quarter. So any improvement in cash flow, as limited as it might be, is now feeding through into the appreciation line as those yields start to level out. Offices still the outlier, remaining challenged from both a yield and a cash flow standpoint, and you can see that kind of dual negative continuing to pull down values in the office sector, but less pronounced though than we've seen in prior quarters. And just to complete the set, the next slide. Oh, hold on a second. Just going to jump ahead. Sorry about that. The next slide there kind of takes the other sector and breaks out the self-storage element within that. Self-storage being 50% of other, and yields here have also leveled out over the quarter. And with that uptick in the cash flow, appreciation also in the self-storage space has moved into positive territory in the last quarter. I want to get into the real detail of what's happening in Q3. So now we're looking at the kind of interplay between yield and cash flow. On the left-hand side, you've got the appreciation, so kind of confirming that it's only offices where appreciation was coming down, lowering that overall ODCE number. All other sectors, appreciation on an upwards trajectory, courtesy of those improving cash flow levels. It's also worth noting other and retail also looks to reach a bit of an impasse, with that yield impact just also turning positive for those two properties this last quarter. The apartment and the industrials, that yield effect is still negative, but it's pretty minor, so possibly just flushing out some property specific pricing factors in Q3. But for all intents and purposes, with the exception of the offices, it's a pretty stable quarter in terms of yield adjustments. So, as I say, starting to see those cash flow gains feeding through to a positive appreciation numbers for the quarter. And we can see the kind of leveling out of those yields on this next chart. So yields for retails, office and industrials now stabilizing, while for offices, they
Sorry, I think that Phil might be froze there. Yeah, maybe I'll kind of take over from here, right? So, but yeah, while Phil kind of being kind of kept an issue with the internet in here, but I kind of look at it, right? So similar to the return as what Phil indicated, right? So the pricing for the industrial, apartment, and retail are clustering, right? So
okay. Am I back, Robbie?
You're back, Phil. So
right, I think I got a freeze there.
You get a freeze on your camera, right? So, but yeah, let me continue on here, right? So I think that if you look at on this chart, right, so they're definitely pricing for industrial and retail, apartment are clustering, right? So pretty consistent to the previous quarter, right? So we continue to see the flattening prices for all property type except for office. The challenge in basically in the office sector continue, right? So that's why we continue to see the increase in pricing. Right? So noted that with the continued decline in valuation, now we're seeing the income return for office to be the highest out of all sector, right? So with quality return of kind of 1.5% as kind of what Phil have shown earlier. Overall as well, we're seeing more and more transaction that kind of continue the support of valuation metrics, right? So and we're also seeing deal with significant number of confidential agreement and bidder. Yes, the higher tenure might be putting a pause, something that's still too early to tell, right? So that's something we're going to continue to monitor. However, though, based on our discussion with client and market participant, there's definitely a lot more optimism today than previously, right? So many have also indicated that there's improvement in capital raising and exit queue as well, right? So and I think with the increase in dry powder and confirmation of the lower interest rate, lower rate going forward, right? So it might eventually impact the cap rate. As we all know, kind of cap rate generally much more correlated to the capital flow. Back to you, Phil.
Okay, good. Hopefully I'm back online. Apologies everyone for freezing just then. We got on standby just in case it happens again, but let's move on and look at the cash flow side of appreciation. So, as I say, all sectors turning positive this last quarter from a cash flow standpoint, so accreted to values, with the exception of the offices there. People are pretty hopefully familiar with the drill that how we run through this, so we relay that cash flow piece to a series of 6 key metrics. The bars then show whether those metrics are having a positive or negative impact on those cash flow effects, and we're actually seeing now more green, thankfully, than red on the card. A few takeaways from this slide that I wanted to note. First, in-place rents are up across the board, as are market rents, with the exception of offices. Offices with an increase in vacancies. We're also seeing a slight dip in occupancy there for the industrial sector. That plus this, the kind of further scaling back of growth rates for industrials, looks to have dropped them a bit down the pecking order this last quarter. On those growth rates, the transition this quarter has seen them edge back up again for apartments. So a new sense of optimism and possibly being priced into that sector there. And if we chart those growth rates down the bottom, you can see that slight uptick in the growth rates for apartments there, whereas the industrial growth rates continue to trend down, but on an absolute basis, those growth rates for industrials are still running the highest of the different sectors. What's also worth calling out on this slide is how the retail growth rates are now coming back close to 3%. And if you take on a one-year basis, those retail growth rates slumped to next to 0 at the earlier part of the downturn, just off the back of the pandemic. So this improvement speaks to the overall turnaround that we're seeing within the retail market. Onto this metric here, the operating expense ratio, that's the cost to revenue carry. That kind of helps further separate out the top from the lower end of the order. Up top, certainly on the retail side, near-term revenue gains are effectively outpacing any increases in operating expenses. For apartments and industrials and offices, pretty much got the reverse of that. So these sectors are still feeling the effects of higher inflation, the carry through of those operating expenses. Down the bottom, the offices, it's pretty much spreads across the card with the exception of that improvement in contract rents. So dips in occupancy, some reduction in market rents, the reduction in those kind of growth rates, increase in the cost to revenue carry, so increase in operating costs, and maybe kind of next to near increase in revenues. I think the key metric for me is that one on the right-hand side, with the increase in the amount of capital that's being projected into the office sector to ensure that it remains kind of fit for purpose and competitive in the wider retail real estate landscape. And you can see how that kind of cost to revenue carry has doubled up over the course of the last 2 years. Next slide here, just to kind of finish off on the individual sectors, expanding back the time series, playing into that narrative as to whether the market is at a turning point on that or not, or close to bottoming out. These charts look at the results from a slightly different lens, so showing the proportion of values that have either increased in green, yellow at a standstill, or red, but continuing to be lowered quarter over quarter. Again, it's an improving set of results that we're seeing across each of the sectors, and for the apartments, the industrials, and the retails, we look to have reached that kind of divide where there's actually more properties where values are rising in green than are continued to be written down in the last quarter. And each of these sectors, it feels like it's more kind of property-specific factors that are really coming into play now, more so than the wider macro fiscal factors. For offices, still the majority of assets are being written down, evidence of the ongoing challenges that are being faced by the office market as a whole. Certain assets, though, do appear to have bottomed out when you look at that 30% in green, but be mindful of any improvement here is clearly coming off a much lower base. So given what we're seeing here, Robbie, based off what you're seeing in the market, would you say that things are now starting to bottom out in those apartment, industrial, and retail sectors? And maybe what lies ahead?
Yeah, I think that to add to what happened in transaction as well, Phil, we're definitely seeing the bottoming in industrial, apartment, and retail, right? So there's definitely an increased interest in this property type. Office, slightly different story. I think it is more case by case basis, right? So even in office, though, we're seeing also transactions start coming back as well, especially the well lease asset, right? So overall, we're seeing liquidity coming back to the market. There's more bidder in transaction. Even the lending side, there's more bid compared to 3 months ago as well. Yes, we will need to see if the higher tenure will slow this positive. I think back to my weatherman role, right? So the wind is blowing from east to west, like the cloud is definitely start to clearing, right? So with this positive discussion, right? So which we don't have much in the past in the last couple of years or so. I think I'm interested to see what others are thinking, which property type are doing better, right? So going to our poll here, right? So basically, again, I think that we have to launch the poll, right? So which sector will perform the best in the next 12 months, right? So apartment, industrial, office, retail, or other. Phil, what do you think, Phil?
I think it kind of almost goes back to that kind of contribution effect where, will one sector have an overriding impact? I think it's hard to call between maybe the apartments, industrial, and retail. So I think the jury might be split between those three and also into others. So I mean, offices clearly has challenges to go through, but it feels like all those other sectors have some upside associated around them, which we've already started to see come through this quarter. So maybe it won't be all on one.
Yeah, let's see the result. Result is apartment, right? So I think I think apartment, industrial, then retail. Like no one pick office, or minimal people pick office, right? So, but yeah, it is kind of pretty kind of consistent, I think, right?
Okay, well, thanks everyone for providing their input there. Let's go back to the overall returns then and see now how they've shaken out across the major metropolitan markets in the usual way that we order these from west to east. We'll go into the detail of each individual section. Maybe actually in the interest of time, Robbie, I'll jump straight to the apartments because we did lose a bit of time earlier on. So going straight into the apartment sector, just to navigate everyone around this chart, what we're showing here are the results here for the last 4 quarters. That's Q3 there. We're then annualizing them. Then over the 2-year time period, so call that the current period of correction. Then 4 years, taking the results back to kind of pre-COVID, see how results have played out since the onset of the pandemic. Color coding here is everything kind of relative to the average return for the sector. So that's the average return for the apartment sector on the right-hand side. So if we start off with just the 4-year numbers, focusing down there, we've referenced it before, where you see that kind of power shift playing out between the Sun Belt and the gateway markets. Really took hold at the start of this pandemic and through that subsequent growth period. A fair amount of that is now being unwound. And so if you look at the 2-year sets of numbers, that kind of current period of correction, the likes of New York, Chicago, Boston, DC have all gone into the green zone there, holding out comparatively well. If you go to Q3, where we're starting to see positive returns across the board, some of those gateway markets are picking up the pace ahead of the Sun Belts. On the flip side, Atlanta, Miami, both dropping off the pace, turning into the red there. And we mentioned it last quarter as well, Robbie, but we're seeing it again, that kind of east versus west dynamic playing out with a predominance of red numbers there on the left-hand side. So, Robbie, any particular themes or kind of reference to specific markets that caught your attention there?
Yeah, when you look at this chart, especially over the 4th quarter or even last, all the entire chart, you can definitely see it's very East Coast, West Coast bifurcation. And yes, gateway market are starting to gain back, right? So we're seeing New York, Chicago, Boston holding better. Not the other category, actually a lot of the Sun Belt market as well, we're showing more negative, right? So I think that out of the West Coast market, we're seeing improvement in Seattle. Phoenix continue to struggle. Being sitting in Seattle here, it's good to see that Seattle vacancy kind of seems to stabilize around 6.9%, and many of this vacancy also in the newer apartment. There's strong outlook in Seattle, right? So with population growth, mandate from tech companies such as Amazon to be back to the office, it will help connect basically the downtown core apartment. A new supply also winding down as well. Phoenix, on the other hand, is kind of facing significant near-term challenges with supply-demand imbalance, right? So despite population growth that's kind of been above national averages, it took a break in Q2, right? So but it turned negative again in Q3. All of them are due to vacancy, kind of that's more than 10% now with lower kind of rent growth. The long term, though, the good thing about Phoenix is the long-term demand tailwind still remain intact. Right, so it is kind of view as a more in the near-term issue. On a positive, Phil, DC, wow, 2.7% total return, right? So definitely one of the market that's seeing improvement, kind of continuation from prior quarter. We all know the federal government, associated professional services firm that make up a large number of employment there, right? So and it may not add job during kind of the boom, but it's also more stable, right? So it's also like if there's any downturn as well as typically all the milder job losses there. New supply have slowed down significantly there. Net absorption have kind of exceed completion year to date. Vacancy just about 5%, and rent growth is healthy. I think that's kind of what's supporting the DC market. So.
Yeah, no, thanks. Great added insight there, Robbie. And actually, if you just look between Q2 and Q3, I think it's just the exception of Phoenix, all those performance numbers are kind of trending in the right direction. So if we kind of zero in on those most recent trends and break the appreciation element of that down into the yield versus the cash flow effects, and off the right-hand side, put those corresponding metrics there for Q2. A couple of things to pick up on. First, you can see that yield downside in Q3 versus Q2 is far less acute, and the cash flow gains are strengthening more so than in prior quarters and turning more positive in the majority of markets compared with the prior quarter. So we've now got more of that net positive trade-off across most of the markets, leading to more markets seeing a positive appreciation for the quarter. But the kind of strengthening cash flow is the backbone to that, and the common theme there for most markets, there are some exceptions, is that improvement in market rents. There's some variances there between the top, the bottom end of the order, but it's also those growth rates that are starting to pick up across pretty much all markets. So I said as before, that kind of renewed sense of optimism that we're now starting to see being priced into the apartment sector under that metric. Let's now pivot across to the industrial sector. Really want to focus in on just that Q3 number there, where you're looking across, you certainly, and this is all relative to the average for the industrials, you certainly got more greens than reds on the card. The narrative is really kind of lopsided because those Southern California markets, still being corrected back. They're the only ones with negative returns this last quarter. Most other markets are running ahead of the average for the sector, posting solid positive returns in each of the last quarter. And as we did with the apartments, let's kind of look at the appreciation side of that into the yield versus the cash flow and put the Q3 metrics alongside the Q3. Not a great deal of difference in terms of the direction of travel of those two sets of metrics, but with less yield pullback in Q3 than Q2, more of those cash flow gains are now feeding through into positive appreciation for the quarter. And then just to open up those kind of positive cash flow effects on this next chart, pretty much market rents in most markets are trending upwards. Yes, they've come down in LA and Inland Empire. Clearly a couple of markets there that overextended themselves in the growth period. And yes, growth rates are still coming down for industrials, more so at the bottom than the top end of the order. But that's also turning positive in the specific CBSA. So we're starting to see that dual positive come through again for the industrials with some improving growth rates in addition to the strengthening in place market rent. So really kind of quite a positive set of results there for the industrial sector with a couple of just exceptions there at the bottom. But any themes that you really wanted to zero in on there, Robbie?
I think if you look at this chart, Phil, the issue is now appeared to just mostly isolated to the LA market and Inland Empire market. Not a tough quarter for these two markets. All technically down to rent. I think the positive side, I think not talking about negative, positive side, generally that the West Coast port, especially LA and Long Beach, are gaining market share. I think previously in 2022, many shifted the market share away from LA and Long Beach to kind of East Coast and Gulf Coast kind of entry point, right? So to diversify the entry point. We're seeing that get shrinking recently, right? So the seaport volume up significantly in LA and Long Beach. That's more than 15-20%. However, though, this doesn't translate to the improvement in industrial market yet, right? So Inland Empire still reported increase in vacancies close to 8% down, partially due to the new supply and also kind of like major move up, right? So the demand is still relatively steady though. There's still a lot of leasing activity there. Just basically kind of the influx of the vacant deliveries that definitely outpace the demand, right? So, and that kind of contribute to the lower market rent. Kind of in comparison, like during the peak, I think that this market was like sub 1% vacancy, right? So it's definitely vacancy up significantly there. LA, very similar story. Vacancy not as bad in the Empire. I think vacancy increased to 4.8% in 3Q. But it is still the highest recorded rate in the last decade, right? So you have 8 consecutive quarter of occupancy losses. They're still leasing, right? So still relatively strong, but just the continued rise in the vacancy definitely impact the rent. That's why we're seeing the negative cash flow effect there as well. Most market have shown improvement, Phil, right? So if you kind of look at it, right, generally the industrial, the demand is still there, right? So seaport volume kind of overall still up year to date. Consumer and economy is still pretty resilient. We also hear the Amazon leasing volume is up as well, right? So it's reported already exceed the 2023 actual, with the Amazon e-commerce volume are still growing at a pretty rapid pace. Yes, the supply issues can we talk about in some market, but the supply pipeline is coming down pretty rapidly, especially with high interest rate today. I think the two market that's going to show positive, kind of the top two one is the DFW, Dallas, and kind of Atlanta market, right? So you're seeing the strong improvement in cash flow projection, especially the market rent side. Atlanta, you look at the kind of fundamental side, all but one industrial job sector expanded payroll, right? So I think recently as well in September, I think the Georgia Port Authority approved the expansion of the Colonel's Island Terminal, which is the nation's largest auto facility there, right? So this coupled with regional rising manufacturing, the auto industry, that generally bode pretty well for the Atlanta market. The industrial demand is strong, right? So that's kind of what the leasing is pretty in line with pre-pandemic average. Net absorption was also pretty stable. Vacancy did tick up a little bit, just to about 8% now, but mostly to the new supply being delivered. But we kind of look at it, the pipeline declining and the demand are strong for the Atlanta market. DFW vacancy actually increased as well, right? So mostly due to the new delivery. But this market also showing a strong net absorption, like leasing also on track as well. Similar market vacancy, kind of new construction kind of tapering off. We expect the vacancies to stabilize, and then you couple the strong market. So I think that's kind of what driving the DFW in Atlanta to be positive. So.
Excellent. Thank you, Robbie. That's amazing added detail. You truly are the oracle when it comes to this. Thanks very much. Let's move then on to the next sector, the more challenged, the offices. So usual suspects then, the 4, the 2, and the 1 year numbers. It's the main gateway metros that have been hardest hit in terms of the performance setbacks. Sunbelt spots holding up better. They're the darker shades of green there. The likes of Dallas, Houston, Miami, Atlanta, also into the other grouping where there's a number of Sunbelt spots there. We've said it before, markets where we've typically seen a greater utilization of office space. The latest quarter, if you look into Q3 there's a bit of movement away from those themes. So we're seeing the level of decline easing off in some of the larger metros. So where it's now good to see, Dallas, New York, LA, all turning green, still on a downwards trajectory from an appreciation wise, but the pace of decline is less so than elsewhere. The flip side of that, we've seen larger performance setbacks there in Miami. Also, that other grouping taking quite a dent in the last quarter. So signaling maybe how the challenges are arguably becoming more widespread on the office side. But at the same time, less maybe market specific, more about property specific factors. But still, these are all negative returns pretty much, without just one exception across the board. If you put the Q3 and the Q2 kind of appreciation breakdown across by each other side by side, similar downside effects. There's a couple of green shoots coming through, but in the main, most markets still feeling the pinch of the challenges that are being played out in the office sector, and those challenges from a cash flow standpoint come in the mold of further cutback in growth rates, some reductions in market rents, but also that capital cost ratio, the increased amount of capital provision that's having to go into the office sector. There's a couple of green shoots over there that are starting to emerge, but a positive movement there on the market rents, some growth rates edging back up, also but from lower levels. But on this basis, Robbie, markets getting close to the bottom. Do you see any markets getting close to the bottom at the moment in the office sector?
Putting a tough question on me, Phil. Going back to, I think, the price, you're kind of showing some green shoot, right? So as we kind of talk about the green shoot, some well-leased office, and you kind of see the heat map earlier, right? So the green on New York, DC, Boston. But note it, this include the income return, right? So if you strip out the income return, which just have been pretty strong, right? So the income return side on the office been stronger than other market. The value is still declining, right? So one reason they're less negative, this market have been down significantly, right? So New York is down like 40 to 60%, which we'll discuss a bit later on, right? So and it's expected that this decline to slow down. So you see a little bit of green part of it just because that the magnitude of the decline previously, right? So I kind of look at the office in three buckets. I know we're going to talk a bit later on, but generally I kind of buckets like occupancy, 90 to 95% or more. 70 to 90% occupancy, less than 70, kind of 75% occupancy wise. Like so, the lower occupancy asset, I kind of look at it. A lot of them are traded more dollar per square foot already, right? So enough valuation already pretty low in dollar per square foot. The greater than 90, 95%, these are more than 7% cap rate already, right? So we also see two deals in the office, one in the West Coast that recently sold, one's actually in the market today that's under contract in the East Coast. Both of them are trading at basically higher than the appraised value, right? So there's the sign of green shoot, right? So on the East Coast deal that's basically on the market, we saw over 200 confidential agreements. There's more than 25 people bidding on it, Phil, right? So there's an office building, right? So with no seller financing, and pricing are pretty competitive. I think that the question mark's still on the middle bucket, like so similar to the mall kind of valuation before, right? So which one of this office in the middle bucket they will move up to 90% plus and survive? Which one they will move down to more than $1 per square foot? The other thing as well, the question mark is which landlord are willing to put more money for leasing on this office space, right? So if you go to the next slide, Phil.
Yeah, just move ahead of 2 or 3 there to this one. Yeah.
All right, this slide, yeah, correct. So if you look at this slide, I'm not going to kind of complete breakdown on it. I think this is pretty similar to what we talk about. We're kind of trying to break it down the office by different category. All right, so we strip out life science and medical office. This is slightly kind of called like a 12, 13% combined, right? So, but you can see there's actually about 30-something% what we kind of call it the high risk, the lower occupancy, the shorter wall in the challenging market. And that category are down more than 50% now, right? So people think that there's no write down, that's pretty significant right now, right? So even the middle bucket there, right? So that the yellow bar, that's already more than 35%, right? So I think the more interesting one is the next slide, Phil, right? So yeah. If you look at the next slide, right? So there's 7 bar right now that's next to the one and highlighted. There's 7 bar that's more than 50% right now, right? So taking New York, for example, close to 60% write down on kind of like a high risk New York office, right? So, and then you look at it overall as well, like so the gray bar in the middle, the 2 gray bar, the general office, and then the overall office is more than 40% write down already. And we're talking about massive losses in office sector, right? So I think that's kind of one thing that a lot of people didn't talk about or may not realize that the magnitude of losses is pretty significant. So therefore, when you write down significantly, that you expect at some point that decline to slow down.
Yeah. Okay, thank you, Robbie. I think we just have one more slide which goes into the retail sector. So Again, we're putting the Q3 numbers in terms of the appreciation on the left-hand side, comparing that with the Q2 metrics. So the main takeaway for the retails is really this transition in terms of the yield effect. So that's now turned positive across each of these different property types, supporting that kind of positive improvement in cash flows, which we've seen in each of the last three quarters when it comes to the retail sector. So the sector really having benefited from right sizing and partly reinventing itself. So it looks like a positive sets of numbers coming through for the retail sector there. So Robbie, any kind of final thoughts on retails?
Yeah, I think that kind of several positive factors that impacting the return, right? So one, we can look at even with lackluster consumer confidence, retail still up, right? So it's more than expected. U.S. consumer are more have pretty much pretty strong spending power still, right? So I think second part is the releasing to higher rent. We know that during the COVID, many of the leasing kind of moved to the lower rent, right? So a temporary leasing type deal. And as these leases roll, we start seeing them rolling into kind of more permanent leasing, more stronger rent, kind of higher percentage rent. Especially some market that's more tourist market, like Las Vegas, we're seeing a big increasing on the rent on that basis, right? So and even some street level, right? So we start seeing some more an asset by asset, not all street level yet, so it's much more specific. We're seeing some of the asset able to lease at a pretty significant rent as well, higher than expected. I think that's what driving the positive cash flow effect on the retail side.
Sure. Thanks very much, Robbie. So I think that's pretty much us through the slides. If any questions are coming through, there's one final question that we just wanted to ask everybody that's dialed in.
Yep, let's roll. Yeah. What this is similar to every quarter we ask this thing, like, so what do you expect the total unlevered property return to be in 4Q, right? So noted that it was a 0.8% positive in 3Q. So the first one, stronger gain, which is more than 3%, so appreciation more than 2%. The B, 1 to 3%, appreciation between kind of flat to slightly 2%, so gradual gain. Or is it basically, so is it less than 1%, basically that the appreciation can drop back down to less than 0%? Phil, if you, where do you pick, Phil?
Well, B seems to be the one where people go most of the time. I was just trying to look on to see if there's been any announcement around the Fed. Yeah, I expect things to, I wouldn't be surprised if people say things will continue to gradually improve. I mean, this will be appreciation turning positive, which we didn't see this quarter, but it was so close. So yeah, I suspect people will be in and around that B bucket.
Yep, right on there, 84%. That's a pretty big number, right? So I think there's still like some negativity, Phil. So there's about 15% thinking that it's gonna appreciation less than 0, dropping back, right? So
yeah,
generally, 84 still.
You're either in there or you're in the camp, but things might get a little bit worse. So, but no, thank you everyone for coming back on that. Talking points, and we've been through the main things there as we've narrated it through. I think for me, there are some positive things in every sector. I mean, even on the office side, where there's some easy off from the declines in some of the larger metros. But if you get the apartments, the industrials, the retail, and the storage, either on the cash flow sides with improving sets of metrics, and on the retail and the storage, where actually those yields have started to flip and start to have an accretive impact on value. So there's certainly some positive themes coming into each of the sectors. So we will be sending out these slides off the back of this. So thank everybody for their time, but I'm sure there might be some questions that came through, Robbie, to pick up on.
Sure. I think the first question, I think people ask that generally almost every single time, right? So with the breakdown of kind of NCREIF going to sub-product type that's slightly different, when do we expect our presentation to kind of reflect this new product type breakdown?
So I think we're hopeful that for the start of next year, we'll be picking that up. So obviously you can go onto the NCREIF query tool and see how that gets broken out. And we're largely reflecting it here, but that will give us a bit more detail to go into. So yeah, hoping through the start of next year, we'll get visibility into this for the ODCE portfolios as well.
Okay. Then the other question could be an easy one for you as well, Phil. Does the capital expense ratio include leasing costs?
It's
So
yeah, so
it
it's
should be
TI,
price.
yes, it's your TIs and your leasing costs in there as well. Yeah.
So yeah, I think this one is basically with pre-COVID leases continue to expire. Are we seeing increased velocity in office vacancy, or is it slowed down? So I kind of look at on general basis, basically office still declining in occupancy, right? So it's an overall, we kind of seeing that continued decline. I think that's one of the reasons that we kind of continue to seeing a continued negative in office appreciation side, right? So, but it is much more, I kind of look at it as asset specific as well, right? So some asset, we actually see an increase in velocity, right? So as increased velocity in leasing, right? So I think that, but it basically, again, the landlord have to willing to commit, like, so basically a pretty high TI, right? So to re-tenant the space up, right? So it is, I kind of look at it as much more specific, and therefore as well as kind of indicated that because of that reason that you brought up, like we potentially risk on the near-term occupancy with the rollover. That's why we start seeing that the well-leased office, we start seeing that the attraction on there, like there's a lot of people are willing to start buying. Just people are start coming back and bidding on this well-leased office. So it is much more about office specific on that basis. I think there's a question, basically, they said that the office is 2.9% return in the other sub-market, right? So which city the largest decline in this other category? I think that we might have to break it out later on. So we have to answer that kind of later on to kind of break it down which city that is, right? So, but yeah, so that we'll get back to you on city on that basis, right? So. There's another question as well. Basically, does Altus monitor secondary market pricing from groups such as ACRE solution, right? So for actual transaction that take place in LP to LP, while it's not scientific, it does provide real-time window to the account to account for redemption liquidity. Thanks for that question. I think that. The good thing is I did have a chat with kind of basically Phil Parker and Joe Ryan from ACRE, thanks to them as well, like a couple of weeks ago, right? So they did provide some insight from secondary market side. Definitely a lot more optimism on that front as well as the discount is start decreasing. We also talked to fund consultant. We also talked to our client, kind of basically, while it is correct, while it may not be scientific, it does provide what we call it the optimism, like from investor point of view as well, right? So, but yeah, we do trying to at least monitor that transaction, or at least kind of have discussion, not a complete monitoring, but again, thanks to them as well, providing some input on their view on the transaction front. The other thing as well, how do you expect the rise in the 10-year this quarter impact 4Q valuation? I think I addressed it earlier, right? It is still to be seen, right? So but there's kind of two sides of this. Based on our discussion, have been more optimism, basically from investor point of view. Basically, while the 10 years have been super volatile recently, right? So even you look at even before, have been super volatile on that front. But the good thing is, depending on what you believe as well, like so some believe the increase in treasury also reflecting with potential growth, right? So some could view as a risk, but overall, basically, based on the discussion, there's still optimism even with the increase with the 10-year. I think that's the question that we have so far, Phil.
Yeah. Okay. Okay, good. Well, we're just coming up to the hour. Just a quick mention, we mentioned this before, that off the back of this webinar, Mike Amthor and myself and Eddie and the team get a flurry of requests for replicating this type of analysis for individual portfolios. Obviously, we're currently providing comparative analysis back to clients that provide data through to NCREIF and our kind of core ODCE index clients. We're also busy working out a platform which will provide portfolio analysis, portfolio trends, market trends, purely on valuation movements. We mentioned this last quarter, and something we're looking to roll out through the early part of next year. So we're opening up this type of analysis to a wider array of clients. If you'd like to understand more about that, do get in contact with Robbie, myself, or your kind of business lead at Altus. But definitely kind of wanting to invest more into this type of analysis, but we thank everybody for their time today, and we look forward to updating everybody in 3 months' time, where I think that we'll be going one day earlier on the Wednesday, but we'll send out a kind of hold the date slot, and off the back of this, we'll send the slides out to everybody with recordings. But thank you, Robbie. Thanks to the team, and thanks to everybody for dialing in and for their interest in this analysis. Enjoy the rest of your day and the week. Thanks very much.
Thanks, everyone.